Welcome to lecture on international financial management. Today we will talk about floating exchange rate regime. Let's begin. A floating exchange rate regime is a system where a country's currency value is determined primarily by market supply and demand forces operating in the foreign exchange market, without central banks targeting a specific parity or band. Unlike fixed exchange rate systems that maintain a predetermined target or peg, in floating regimes, central banks intervene only occasionally and minimally to smooth out excessive volatility rather than defending a fixed value. This regime allows the currency to fluctuate freely according to market dynamics, accurately reflecting key economic fundamentals, international capital flows, and shifts in investor sentiment across global markets. It is the most common exchange rate regime among advanced economies today, underscoring its widespread adoption due to the perceived benefits like flexibility and resilience in modern financial systems. Exchange rates under this system are primarily determined by the dynamic interplay of demand and supply forces within the vast foreign exchange market, reaching equilibrium based on market participants' actions. Key factors influencing demand and supply include trade balances from exports and imports, differing interest rates between countries, varying inflation levels, and significant cross-border capital flows. Although central banks may occasionally intervene in the market to reduce excessive volatility and stabilize conditions, they generally avoid targeting or maintaining a fixed value for their currency. For example, major currencies such as the US dollar, the euro, and the Japanese yen all operate under floating exchange rate regimes, experiencing daily fluctuations driven by market forces. Historically, the United States adopted a floating exchange rate system following the collapse of the Bretton Woods Agreement in 1971, marking a major shift in global monetary policy. The United Kingdom followed suit, adopting floating rates after the exchange rate mechanism crisis in 1992, which exposed the limitations of fixed pegs under pressure. Japan also transitioned to a floating exchange rate system in 1973, further solidifying the global trend toward flexible regimes among major advanced economies. Today, major currencies, including the US dollar, euro, Japanese yen, British pound, Canadian dollar, and Australian dollar, continue to operate under floating regimes, often with some managed elements. Many advanced economies and some emerging markets utilize floating exchange rates, though several adopt managed floats involving limited central bank interventions to guide market movements. One significant advantage is monetary policy independence, enabling central banks like the U.S. Fed to freely adjust interest rates without the burden of defending a specific currency peg. Floating regimes facilitate automatic adjustment mechanisms where exchange rates naturally respond to trade imbalances, such as surpluses or deficits, and fluctuating capital flows. They serve as an effective shock absorber, providing economies with the flexibility needed to respond and adapt to various external economic shocks and disturbances. However, a key disadvantage is heightened volatility, as exchange rates can fluctuate significantly and unpredictably, creating substantial uncertainty for international traders and investors. Another major concern is imported inflation, where a depreciation of the domestic currency sharply increases the cost of essential imports, thereby fueling higher domestic inflation rates. Floating currencies are particularly vulnerable to speculative pressure from investors, which can lead to excessive and abrupt swings, driven primarily by changing market sentiment. Floating regimes prove sustainable when bolstered by strong institutions, credible monetary policy frameworks, and deep liquid financial markets, as noted in International Monetary Fund Article 4 guidelines. While short-term volatility presents a clear drawback, floating exchange rates often demonstrate greater resilience over the long run compared to rigid fixed regimes that can collapse under stress. They enable economies to adjust naturally and smoothly to evolving global conditions, thereby fostering enhanced adaptability and overall economic stability in dynamic environments. In conclusion, floating exchange rate regimes offer crucial flexibility and monetary policy independence, positioning them as the preferred system for most advanced economies worldwide. Despite challenges like volatility, they remain generally sustainable and empower economies to better adapt to shocks, contributing vitally to global financial stability. For finance professionals and college students alike, a solid understanding of floating regimes is essential for effectively analyzing global financial markets and making well-informed investment decisions. Thank you for watching our lecture on international financial management, focusing on floating exchange rate regime. See you at the next lecture.